Hey, what's up, guys? Welcome back to the exciting July market update with Kenny Simpson with C2 Financial. Brought to you by the Simpson team. Remember, July market update is when we look back into June. So if you guys, the first time watching this, joining this, welcome. Welcome to my market update. I'm getting better and better at these. So hopefully you're watching, sharing, liking, giving me feedback. What we cover in these is we go basically over market data month over month. The data has been getting really, really exciting and because it's changing. And so there's lots to talk about. Before I get started, for those of you that don't know me, again, Kenny Simpson, I am a mortgage broker by choice. I've been in this business for about 18, 19 years. I help people finance 1 to 4 unit properties, whether you're buying a primary, second home, or investment property. I am your guy. And we can do it all from down payment assistance programs to if you're a complicated self-employed borrower, or you're a real estate investor and you have too many properties and complicated tax returns, we got you covered. If you need to reach me, my information is on the How to Reach Me page. Otherwise, I appreciate your time. We're going to jump into it, and we got some exciting stuff to talk about. First slide, economic slowdown. I don't think that's a shocker for most of us. Things are changing at a rapid pace. That's why I love when we look over this month over month. Recession fears surge among CEOs. Survey suggests 3/4 of global CEOs say that we are in a recession or will be in one of the next 12 to 18 months, according to a new survey. Well, I'd love to make a comment before I jump into the next quote here. July of this month, I think it's July 28th to be exact, we will have the updated information, which is the GDP numbers for second quarter. First quarter, I believe, came in at negative 1.6. Yes, that's a negative 1.6. Second quarter is supposed to come in at negative 2.2. The definition of a recession is an economic slowdown, or one way they know there's an economic slowdown is their quarter over quarter, two negative quarters, two negative GDP quarters. So that means technically we all think we are in a recession. We've been in one for 20 days now. So when we go through this slide, we'll talk about it, but we think we are in a technical recession and the reality of the recession, the psyche and all that's coming. So we will see how this progresses over the next 30, 60 days. Throughout history, during a recessionary period, interest rates go up at the beginning of the recession, but in order to come out of a recession, interest rates are lowered to stimulate the economy. Moving forward, historically, we have seen a repeat uptick in interest rates followed by lowered interest rates. So guys, basically, to make this simple, when they raise interest rates, they take money out of the system. And when they lower interest rates, they put money into the system. So right now, think about the interest rates are going high, but money is coming out of the system like a low tide at a beach. And soon the high tide will come where they will flood the system with liquidity, buying back mortgage-backed securities, dropping interest rates, and banks will start freeing cash that they're sitting on. And they're sitting on it because the Fed is paying them to sit on it, because nobody's talking about that. But if you listen to all of our podcasts, all of my great content, you will know this. So let's move on. Mortgage rates and recessions. Here we go. We're looking at this, 1983 interest rates were at, almost 18%. I guess it could be worse. So today, interest rates, obviously, we're looking at the chart here, 2022, they're coming off the bottom. You know, this time last year, interest rates, you could probably lock in a 30-year fix on a conforming with a 2.875, 2.75. Don't have all the numbers in front of me. Today, that number is definitely 2% higher, a little bit more than 2% higher, depending on the lender, depending on where you're quoted, probably 2 to 3% higher for sure. So cost has gone up. Obviously, when we have a recession, the start of a recession, the cause of recession usually could just be by last time was some economic, bad news, bad mortgages. We were in a financial crisis last time. That's what really caused it. But now the feds are purposely raising rates to slow things down. We're watching it before our very eyes. So if you've never been around for this magical trick they're doing, well, welcome to the show. And it's getting very interested. And it's going to get very, very more interesting as we move along. Mortgage rates and recessions. So the 1980s, 6-month duration, interest rates went from 16 to 11.8. 1981-82, wow, that was still around the same period. 18 to 13. Early 90s from 11 to 8.8. That's when they hit their first refi boom and the rates came out of the double digits. People always told me back in the 90s, it was the first time they sent out a rate sheet or a marketing flyer that said, you can refi at 9.99, and people were jumping out of windows. So if you think you can't buy real estate, you can't invest in real estate, you can't, afford it, or it doesn't make sense at high rates, I do agree with you. But before they gave all of us these lovely low rates over the last, what do we want to say, 15, 16, 17, whatever, 20 years, rates were much higher. Early 2000s, March 2000, that was the dot-com boom. Kind of like dot-com crash, kind of like there is a crypto crash right now. That was in 8 months from 7.4 to 6.8, not a huge drop. Great Recession, that's where the housing correction hit, where we gave a bunch of shitty loans to everybody. Or we made a bunch of shitty loans to people that shouldn't have got them. That was 1 year, 6 months. Wow, it went from 6% to 4.9. And COVID-19 recession, February 2020 through it to April, the recession lasted 2 months because that good old Fed printing machine put that thing on steroids, pumped it full of I don't know what, and shot at a can a bunch of money. Went from 3.8 to 2.8. In 2019, if you guys didn't know it, 18, things were kind of getting crackly in the market. Feds came in and actually started buying mortgage-backed securities, and interest rates, actually a refi boom hit in 19. And then obviously we had the big refi boom in 2020, 2021. And now we are not in a refi boom, but basically everybody doing stuff now is purchasing. Over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak during the recession to the trough. In many cases, they continue to fall after the fact as it takes some time to turn things around eventually when the recession is technically over. So basically what they're talking about here is obviously interest rates. Let's just say, pick a number. The 30-year interest rate is, let's just call it 5.5 to use a number. If 1.8 percentage points, let's say that drops to 3.5, 3.75, by the time, we hit a recession, 2%, that's going to be crazy for real estate again. And obviously it could continue to decline depending on how bad the market economic data is. So, you're watching this all before your eyes. Mortgage rates, by the way, guys, they're way higher than anybody projected. So I see this projection. They're lying flat. They're saying in 2023, interest rates are supposed to go up. Not sure if I agree with that. A lot of these people that predicted these charts in the beginning of the year were completely wrong. But the reason why I don't think they would keep rising and go up, I think we're going to have some plateau or falling, is because if we do hit a recession and the consumer pulls back and we have, not good economic news, lower GDP, consumer stops spending, we hit a recession, I believe interest rates will naturally start to fall. Recession does not equal a housing crisis. We all know this. 1980, 1981, when we talked about that recession, 6.1 up, 3.5 up on 1981. 2001, it went up. In 2020, it went up 6%. Can there be declines? Yes. Sometimes you enter a recession, it's decline, and when you exit a recession or you leave coming out of it, because rates and stuff fall, it tends to recover housing, so it doesn't stay down long. Inventory update. Here we go. The breakdown. Offers received, offers over asking, sales down, inventory up. So offers received down, offers over asking down, sales down, inventory up. Actually, right now as we record this, I had a client put a $70,000 offer over the list price And there's 3 other offers on the table. We will find out today if he gets it. So I don't know if it was the agent purposely did not price the property right, but that's what I think happened because I have not really seen many of those. And there's a bidding war on it. There has been pickup in the inventory that we've seen recently, but it is not far from a big increase in new listings, but rather a slowdown in the pace of sales. And remember that month supply measures the inventory of sale relative to the pace of sales. Some inventory, fewer sales means more supply. And we talked about this too on the podcast. We had Logan from Housing Wire talk about what you're seeing now is you are seeing inventory pick up. You're also seeing days on the market longer. I think if you have a house that's priced right in a great neighborhood with the schools, walkability, whatever people want, it is getting the offers, you're getting it sold. If you are trying to sell a dilapidated pile of garbage and over for expensive price, it might not pan out. It might not work. So you might be price cutting and you might be getting low ball offers because people don't want to overpay for those kind of properties in this current environment. Home sales have eventually returned to the levels seen in 2019 prior to the pandemic after 2 years of gangbuster performance. So that is the chief economist at NAR. Active inventory continued to grow, rising 21% above 1 year ago. In other words, we're starting to add more options, but the market needs even more before home shoppers have a selection that's roughly equivalent to the pre-pandemic housing market. That's the chief economist at Realtor.com. I agree. We do have more inventory. It's not enough. Take a neighborhood in San Diego, Encinitas. I have a client looking for a property. She says there's literally nothing on the market that she wants to buy. So if a house comes on the market and you have a bidding war, that's because there's just no inventory. I'm not sure in a market like San Diego, yes, we're going to get more housing on the market. Houses on the market, I don't know if it's going to make that much of an impact. I know areas like Utah, Arizona, Texas, Florida, they might have more inventory. Places in California like Riverside are getting much more inventory. So certain outlining areas, certain areas in different markets, you will start to see a lot of inventory, probably more price reductions. You might see more of a housing correction there, but will that be long term? We just don't know. We should start seeing less competition. We're already seeing that. Fewer bidding wars. We're already seeing that. And therefore, less upward price pressure. All those are true. In fact, a simple analysis shows that a 1 month increase in supplies results in a 3% decline in annual house price growth. And preliminary house price indexes are already showing moderation in house prices in April. So obviously this is... we're looking backwards when we're reading this. This is data from, June, maybe May. So, this is becoming more and more and more of a buyer's market. Accelerating home prices do not mean depreciating home prices. Interesting. Home price forecast for 2022. The average for Fannie Mae, Freddie Mac, CoreLogic, HPES, NAR, Zelman, and MBA. Wow, MBA, Mortgage Banker Associates, you guys are really they're really way down, 2.7, so the average would be higher. So we're looking at 8.5% average for the home, so prices to increase. We'll see what happens. Interesting. Most of the increase might have come in the beginning of the year too. The root issue of what drives house prices almost always is supply and demand. Now, interest rates affect that. When interest rates go up, guess what? Fewer buyers. The demand goes down, thus prices are going to soften or not be as cray-cray as they have been. And that's what we're seeing right now. That is Dave Ramsey, Mr. Conservative. So obviously, guys, interest rates went way higher than we expected. That is causing issues with demand. Here's why. People think high prices. We're going to see more price reductions. Fewer buyers can qualify and, yada, yada, yada. You guys get it. We're all talking about it. We're all seeing the correction, slowdown, whatever we're going to call it in the housing. Single family housing units completed. So we had 14 straight years below the 50-year average. So if you want to know why we do not have supply, that is one of the issues. And if you want to know why we can't build fast enough, well, go talk to your local politician. And there's all this gridlock, especially like here, it takes too long. There's way too many cooks in the kitchen. It's too expensive. And quite honestly, politicians should not be running in charge of this stuff. They should leave it to a private sector, somebody that knows what the hell they're doing. Because if we had 14 years of below average, trust me, guys, this is not a lack of money. It was not a lack of confidence I get coming out. But in the last 7 years, it has not been lack of confidence or money or willing. It's literally like very hard to get stuff done. Some states where we are here in San Diego, for example, California, it's much worse. And there's other parts of, particular parts of California, let's be honest, that is even harder to get done, like San Francisco. U.S. population by generation. Oh, this is a cool chart. So, Generation Alpha, 2013. Wow, you guys are Alpha, 2013 to present. Generation Z, 1997 to 2012. Millennial generation, 1981 to 1996. Generation X, 1965 to 1980. Baby boomers, 1946 to 1964. In the silent generation, silent, it's 1928 to 1948. I'm not really sure what the hell that means, silent, but I think we can pick up on that means. Maybe they ain't around anymore. The peak home buyers are, we know, they're the millennials, guys. And Generation X too, but you know, millennials are the big ones, and that's who's going to be the buyers over the next probably 5 years. Experts don't believe the market is in a bubble or crash, or a crash is in the cards. Like during the Great Recession, the nation is still suffering from a housing shortage that has reached crisis proportions at a time when many millennials are reaching the age when they start to consider homeownership. That's likely to keep prices high. Basically what they're saying, guys, is number one is the millennial generation. I don't know how many, I think the population's, 80 million, 70 million, something like that. They are graduating. They are getting engaged. They are getting married. They are getting girlfriends. They're actually moving out from their parents' house. They're a little bit different. COVID actually fast forward people saying, I want to buy a house. I want to have a place to call home. I don't want to be stuck in an apartment or a condo or high rise or this. People probably believe we might go back into lockdown or something. So housing is becoming more and more important. On top of that, we are now entering into a recession or something. Housing has done really well compared to the stock market, crypto, gold, art, all this stuff. I'm not saying all that stuff is not an investment or a good opportunity, but housing is doing really, really well right now and really resilient. So a lot of people are watching and they like it. Obviously, it's more conservative returns. You can touch it, feel it, own it. They cannot like the money that we have in our wallets, this fake garbage that they can print a bunch of. You cannot print 1 million houses in one day. Average days on the market. Let's see. So the average days on the market, I was looking back here in 2019, July of 2019, for example, I'm just looking pre-pandemic. We were about 26 days on the average on the market. Today, May, it says we're at 16. I don't think it's done. So yeah, quite a bit of a dip. We were at 17 days for a while. We peaked in December, January 2020. We're at 41 days. So obviously, if you look here, if you're looking at this chart, when you go through the holidays, it tends to peak because obviously buyer demand slows down. Nobody really wants to move to a new house during the holidays. They want to host their parties. New homes selling fast. Really fast. 2.4 months, new homes are selling. So it's at an all-time record low still. Pending home sales. 100 equals historic healthy level. So way over that chart. It dropped obviously in COVID. Now it's way up. Well, that thing fell off a cliff. Percentage of distressed properties. we're still seeing foreclosures and short sales are still coming in less than 1% of sales. It's crazy. To be honest, there's still a lot of workouts. There are a lot of people that low mods, this and that. So these people are getting lucky and kind of bailed out, but still that number is awfully low still. Change in sales prices year over year. Basically, the low end is still getting crushed, but 500, 750, 750, 1 million, 1 million up. You're seeing over 20% change in sales. Buyer demand. Slowing activity continues to slow nationwide. Year over year increase is showing activity. May 2022, Michael Lane, Vice President and General Manager, showing activity continues to be at levels lower than we're used to seeing at a time of year, pointing to the market transition. Following the surge in mortgage rates, it's reasonable to expect that showing activity will continue to ease, especially when compared to last year's historic numbers. Obviously, the average is 18, but the West looks like we're getting hit the hardest. The slowings are down 45%. Mortgage credit availability. Lending standards, still great. Look at this chart month over month. Not much is changing. Looks really good, healthy. The borrower, I can tell you right now, the borrower looks healthy, healthier than last cycle. Hot products. Fannie and Freddie allowing ADUs and counting the income. So previous, just 3-4 months ago, Fannie would allow a single family with an ADU, no problem, would not give the income. Now Fannie allows single family with an ADU, will give you the income. Freddie Mac, on the other hand, allows a 2 or 3 unit with an added ADU, and they'll give you the income. So if you're in the ADU business, or you do ADUs, or you're trying to finance, this is huge news. It's also huge news. A lot of people could not use that additional income, so it did not help with qualifying. So that's, exciting, big news right there. And finally, how can you reach me again? You guys have all of my information. Thanks again for watching. Trying to make this quicker and easy. There's really, as you can see, the market is becoming a buyer's market. So you are starting to see, instead of homes that are listed, I'm picking a number at 500, go to 550. You're seeing people write 500,000 offers with can you give me a seller credit of 10, 15 grand? Why? Because a lot of people are buying down rates and they want the seller to pay for it. So the sellers are not, they're not having to write these crazy offers, no contingency, quick closes, all this stuff. You're getting your 30 days if you need it, your contingency, you need it, your inspection, all that stuff. So for the buyers looking in a much, much better position to buy a property, yes, interest rates are higher, but if rates come back down in the coming year, then you'll be able to take advantage and refi out. I think if inventory does not go up at a dramatic rate, and when rates lower, we will be right back into maybe switch back to a seller's market. So between today and when QE happens, if you are buying a home, you're probably paying a higher interest rate, but you're definitely paying a lower price than you would a year ago, 6 months ago. With that being said, I appreciate you guys watching. If you have any questions, please feel free to reach out with me. Please share this with anybody at all that needs this. And I look forward to catching up with you guys next month. I'm basing by next month, we will have a 75 basis points hike. We will know where GDP stands, and we might be able to finally admit that we are actually in a recession. Until then, have a good month, and we'll see you guys soon.